Welcome back, everyone. If you love a good financial mystery, you are in exactly the right place today. In this explainer, we're unpacking National Bank of Canada's Q3 2026 results. Now, on paper, this earnings report looks like an absolute blockbuster. I mean, truly stellar. But when you look at how the market reacted, it's like we're living in two completely different realities. So we're going to decode this earnings paradox, separate the flashy headlines from the underlying truth, and see if we can figure out exactly what the market saw that the headline writers totally missed.
Okay, let's dive right into this glaring contradiction. On one hand, earnings jumped a massive 26%, and total revenue blasted right past the $4 billion mark. For a major bank, those are the kind of numbers that usually have investors popping champagne. But on the exact same day these numbers dropped, National Bank stocks slid roughly 5% on the TSX. Think about that. A massive headline beat met with a bleeding stock chart. It's a total paradox. To understand why investors suddenly ran for the exits, we first need to look at what looks so good on the surface.
Part 1. The shiny surface. Headline numbers that impressed. The bank reported adjusted earnings per share of $3.39, and this wasn't just some slight edge over expectations, it easily crushed the consensus estimate of $3.22. In the banking world, beating consensus by 17 cents a share is a massive win. It's a huge signal of profitability and overall operational efficiency.
And that earnings beat was driven by some really spectacular broader metrics. Net income shot up 26% year over year, hitting $1.36 billion. That surging net income is exactly what drove total revenue to that staggering $4.1 billion figure we just talked about. I mean, honestly, if you stopped reading the earnings report right here, you'd be incredibly bullish.
Now, what's really interesting is where all that growth actually came from, because it was strong across the board. Wealth management was up 21%, heavily driven by higher fee-based assets and generally strong markets. Personal and commercial banking grew a very healthy 14%, fueled by loan growth and higher interest rates. And then you have that massive third segment, capital markets, up a staggering 32% year over year. At first glance, that 32% jump looks like an absolute home run. But let's put a pin in that number for a second, because as we dig a little deeper, we might find it's actually a bit of a mirage.
Before we bust that illusion, though, there was one subtle crack in this shiny surface. Credit provisions ticked up to $246 million, up from $203 million last year. Now, the CEO, Laurent Ferreira, rightly pointed out that the bank is extremely resilient. It remains one of the best capitalized lenders in the country. But this increase in provisions tells a story. It's a pretty clear sign that the bank is quietly setting more money aside, essentially bracing for a softer, rougher economic environment ahead.
Which brings us to the million-dollar question. If earnings are crushing estimates, revenues are hitting records, and capital levels are rock solid, what on earth spooked investors enough to trigger a 5% sell-off? Well, the market doesn't just drop 5% by accident on a headline beat. They saw the bruises beneath the surface.
Part 2. The investigation. 3 hidden red flags.
Here is red flag number 1. Remember that massive 32% year-over-year growth in capital markets we just looked at? Well, sequentially, meaning from the previous quarter to this quarter, revenue in capital markets actually dropped 3%. The momentum completely stalled out. And honestly, it gets worse when you compare it to the competition. During that exact same period, larger peers like RBC and TD were actually reporting rising trading revenues. So National Bank didn't just stall, they actively underperformed relative to their peer group. Suddenly, that 32% year-over-year number feels a lot less like a home run and a whole lot more like a red flashing warning sign about market share.
Let's move to our next clue, which builds perfectly into red flag number 2, the CWB Integration Delay. As you know, last year, National Bank acquired Canadian Western Bank. Markets absolutely love acquisitions when they bring swift synergies. But management just shifted the goalpost here. They announced that the expected capital benefits from that deal actually won't materialize until late 2027. And to make matters worse, when those benefits do finally arrive, they're going to be at the lower end of previous guidance. You can see how this significantly frustrates investors who are banking on a much faster, much more lucrative timeline.
And red flag number 3 hits right at the core of profitability. Operating expenses jumped nearly 12% year over year. A 12% spike in the literal cost of just running the business is a massive hurdle to clear, especially when the broader economic environment is getting tougher.
So the crucial takeaway here is how those rising costs collide with intense margin pressure. Net interest margins in the personal and commercial banking segment dropped by 7 basis points.
Why? Because right now there is cutthroat competition among banks to secure deposits. Turns out they actually have to pay up for our money. So add it all up. Stalling capital markets against peers, delayed acquisition benefits, rising operating costs, and shrinking margins. Suddenly, that headline beat doesn't feel quite so clean anymore, does it? Investors are looking at the actual quality of the earnings, not just the flashy top-line number.
Part 3. The macro threat. A warning from the top.
CEO Laurent Ferreira really did not mince words during this earnings call. He explicitly warned that Canada is facing an, quote, escalating trade conflict with the United States. He stressed that the outcome is incredibly hard to predict right now and that the looming threat of tariffs and trade uncertainty is going to act as a heavy weight on both business investment and consumer affordability. When the leader of a major national bank uses a massive platform like this to issue such a stark warning about macro threats, stock buyers tend to freeze. It's a pretty chilling message for near-term growth.
Now, to be fair, it wasn't all doom and gloom from the CEO. We definitely have to balance the scales here. Ferreira did strike a note of long-term optimism. He pointed out that Canada is making the right moves toward economic resilience by focusing heavily on infrastructure and energy projects. Plus, he really emphasized that National Bank's exceptionally strong capital position gives it the ultimate flexibility to weather a potential downturn far better than most of its competitors. The message was essentially, yes, a storm is coming, but we have a very sturdy ship.
Part 4. The verdict. Valuation and investor outlook.
And this brilliantly illustrates the massive divide in how different investors are viewing National Bank right now. If you're a growth-oriented investor, the cons are glaring. For instance, the financial modeling platform Guru Focus recently flagged the stock as roughly 47% overvalued, which suggests it's trading way above its intrinsic value. Combine that lofty valuation with the trade headwinds and those integration delays we just broke down, and the next 12 to 18 months look like a very bumpy road. However, if you are an income-focused investor, the big pro is basically impossible to ignore. The bank continues to offer a very solid dividend yield, and that payout ratio remains completely sustainable. It's a reliable payer in a highly uncertain market.
Which brings us to the ultimate question you have to ask yourself after going through this explainer. The stock might look somewhat cheap compared to its own historical average, but is it cheap relative to the current risks? Is a fundamentally strong operational quarter actually worth the price of admission when massive macroeconomic storms, not to mention internal integration delays, are brewing on the horizon? That is the exact tension at the heart of National Bank's Q3, and it's the puzzle every focused learner should be watching as we head into the next quarter. Keep analyzing, keep questioning, and I'll catch you in the next explainer.